Since the beginning of the year, the S&P 500 has become a pressure cooker. In fact, for the first time in 60 years, the spread between the highest and lowest close in the first 32 trading days is only 2.67%. That's extremely narrow and unsustainable. Additionally, the VIX, often referred to by the media as the fear index, is now moving higher. Adding additional concerns, the Federal Reserve on Wednesday revealed a more hawkish tone than expected, even hinting towards a possible rate increase. We'll talk about all of that, check in on day 275 of the S&P 500 Bearish Divergence, update you on the AeroVironment and adaptive biotechnology trades, and take a look at a possible bearish trade idea on the energy sector. All of that in today's Tradesmart University market forecast. Let's start with this historic range on the S&P 500. Now, I've created an indicator so we can see anytime the S&P has traded within 2.67 of its highest close and its lowest close for 32 periods. What's unique about this range is it's the first 32 days of the trading year. You've got to go all the way back to 1966 to find another year that has started in this narrow of a range. Now, a way to think about this is like you would imagine a pressure cooker. The longer and tighter that range squeezes, the more pressure that's building up in the stock market. And we can see that illustrated with the Bollinger Band. If you've not worked with the Bollinger Band indicator, this would be a great opportunity to put it on your chart and watch how this behaves. Notice that the bands at the end are coming together. That's the pressure cooker intensifying the pressure within it. Now, if we remove the constraints of the calendar and we look at any time the S&P has traded in this 2.67 range for at least 32 days, we can start to get an idea of what has happened historically. We've got to go all the way back to 2018 before we start seeing other periods of time where the range has been this tight. And while it's not an exceptional predictive indicator, we can see that several times we have measurable sell-offs going forward. Not always, sometimes it continues higher, but oftentimes if we take a look at these, you can see that the market did indeed sell off. So while this in and of itself is not necessarily a great predictive indicator, as you've seen in several of our recent market forecasts, I think we're starting to stack evidence that shows there's more weight, there's more opportunity on the bearish side of a move than on the bullish. As you've seen in previous market forecasts, we're starting to see more evidence of a potential bearish move for a season. Not a bearish trend, not a crash, but a bearish move for a season. One of those pieces of information that I've started to look at is the VIX. Now, the VIX is often referred to by the news media as the fear index, and well, I think that's an unfair characterization of it. That's what we'll go with because it does, in my opinion, convey the implications of the VIX. And you can see that since the beginning of the year, the VIX has been climbing higher. What you need to understand is that the VIX works inversely to the S&P 500. If we make these both line graphs on here, you can see that as the VIX goes up, the black line, the S&P goes down. As the VIX goes up, the S&P goes down. As the VIX goes up, you get the point? As the VIX goes up, the S&P 500 goes down. What did we say is happening? The VIX is going up, which is adding some additional evidence to my bearish concerns. Adding fuel to that flame is the Federal Reserve, who yesterday said several of their members are open to rate hikes. If you're unfamiliar with this terminology, it would be what we called a hawkish perspective. Several in the industry, this is Reuters, and several others have reported a more hawkish tone to this report that was released yesterday. Let's relate this to the stock market. Generally speaking, not always, but generally speaking, if interest rates are going up or if they're even hinted at going up, the stock market tends to respond negatively or bearishly. One last thing to check in on before we start looking at our trade ideas is our epic bearish divergence that's been going on, the S&P 500. You can see we've been continuing to make higher highs on the S&P 500 while the MACD indicator is making lower highs. We've been talking about this for several days now. And well, unfortunately, this particular indication does not come with a timeline. It does come with a bias, and this would tend to resolve itself in a bearish direction. And this is across the board. If we take a look at the Nasdaq too has bearish divergence on it. If we take a look at the Dow Jones Industrial Average, it too recently has started to have more significant bearish divergence on it. Even the semiconductor index itself has been struggling to make consistent new highs, and we've now seen a resistance that has begun to form on the semiconductor index. And as we often say, as the semis go, so goes the rest of the market. Now let's check in on our trade ideas from the last market forecast, and I've got a new trade idea coming up for you in just a second. So AeroVironment, we jumped into this trade. We were looking at it in Power Trader, and we talked about it also in the market forecast, and this is profitable and heading on up. I'm highly optimistic for AeroVironment. I will not personally let my trade go all the way to $385. I'll be raising my stop to above break even, so we can't lose money on this trade, and I'll be setting a trailing stop and putting cash in my jeans as this moves deeper and deeper into profitable territory. Great job on AeroVironment. Let's also take a look at Adaptive Biotechnologies Corporation. If you missed this trade from our last market forecast, I think there's still an opportunity, maybe even a little better opportunity to consider a trade entry on this. We've got our stochastic that's below 20 and rising. This is kind of my indication that a stock is on sale. It's trading cheaper than it normally does with some upside potential. We, in Power Trader, identified this orange line, which is called a confluence zone using a tool called Fibonacci analysis. You can also see that we've defined this uptrend, and so far price action is respecting both of those, and I'm optimistic it's going to move into profitable territory very soon. Now, let me leave you with one trade idea. I'm going to come over here and do something I don't always do, but I'm going to consider a bearish trade on the energy sector. You can trade this as an ETF. It's ticker symbol XLE. And while I don't typically trade counter trend, this is so overextended and our MACD indicator is getting ready to cross down. This is showing you a short-term trend direction. And while I think we could continue on a little higher, this trade is setting up and you should keep your eye on it. One of the tools that I want to point out to you, if you're unfamiliar with it, is called the Ikenashi candlesticks. These help clarify if we're in a bullish or bearish trend. And you'll notice these look a little different than a traditional candlestick because they typically only have wicks on one side and they typically stay the same color for quite some period of time. What you need to be aware of and what identifies a change in the trend is when you start seeing the colors mash up together and you start seeing wicks on both sides of the candlestick. That would tend to suggest that this is getting ready to roll over, which is also supported by our MACD indicator getting ready to roll over. Another thing that's interesting to look at here is about how long these parabolic moves tend to last on the energy sector. Let's come and measure this one. I'll start with that first green candlestick and go to about when it rolled over. That one's 53 bars, and that's a little longer than usual. Let's check out this one on the way here. This one was about 18 bars or so. Let's see where we're at right now. From the bottom of this trend on up to where we're at 38 bars, 38, 39 will be today, give or take. I think this trend, this parabolic move is running its course and it's running out of gas. And here's what I expect could happen. If the S&P does get a little bearishness in its veins, I think that could be enough to pull the energy sector over. Again, I'm not saying the energy sector is going to crash and go to zero. I'm saying we need a little bit of a pullback, and there could be an opportunity as this MACD line crosses down to participate in some of that bearish pressure on the market. On Sunday, I'm going to be getting together with some friends live and talking trading. If you'd like to join me, this is totally free. The link is in the description. We're going to be talking about the F.A.C.T.S system of trading. There's 3 tools we use to qualify the very best trades: fundamental analysis, a trade catalyst, and technical analysis. We then multiply that by 7 specific trade setups that we have, which gives us the highest quality trades that have exceptional targets and get there quickly. If you want to come talk trading and learn a little bit more about the F.A.C.T.S system, come join me on Sunday with my trading buddy Alfonso. We'll be glad to see you there. The link is in the description to register for free. Until the next time, blessings and favor on your trades.